major thing for today is to understand what is pillar 1, what is pillar 2, what is the proposal for digital taxation, and this task Shri Rasmi Ranjan Das will be doing. So Das sir, I will request you to take as much time as you require and please explain to us pillar 1 and pillar 2. Thank you, sir.
Thank you, Rashmin ji. Pramod Kumar sir, Otswal ji, Harit ji, Anjali ji, Sunil ji, and other distinguished participants and guests. Let me express my sincere thanks to Institute of Chartered Accountants of India, Ahmedabad branch, for inviting me to this August gathering. It's really a privilege for me to share my views with such a distinguished audience, and an opportunity to learn from some distinguished panelists like Pramod Kumar ji, Otswal ji, Rashmin ji, and others who have been thought leaders in this process. Rashmin ji, particularly, as you were saying, the digital group that he was mentioning, which India established both in 97 as well as in 2016, he was one of the most active participants in those groups, and his contribution was immense in those reports which India produced first 25 years back, and again bringing back equalization levy, which is something first time India did. In fact, he was referring to Robert Stack. Robert Stack recently spoke to me in some context, and in fact, he was saying that we were surprised the way India took up and came out with equalization levy hardly within few months, couple of months. I think the reports came in around October 15, and India was ready with equalization levy in February 2016. And India, both from the academic world, as Pramod Kumar sir was saying, the practitioners and Indian revenue have been the thought leaders in the process, but it is gradually a vindication of the stand, because all countries now realize the importance and the justification of what we have been saying. I think not only from 99, in fact, I always refer to 1976, when India was one of the pioneering countries to usher in source-based taxation. Now, before I go into details of Pillar 1 and Pillar 2, as I have been asked to, I must clarify that the views expressed in this forum are my personal views and do not necessarily represent the views of the government of India. Now, as was being referred to by Rashmin ji, that the rules that govern allocation of taxing rights, which means who can tax, and also profit allocation, I mean, how much can you tax, even if you have the taxing rights. So this allocation of taxing rights among countries in respect of income of cross-border operations, these were framed sometime in 1920s, and these are no longer fit for purpose in 21st century. As one commentator has said, most stuffs from 1920s sits in museum, except the international tax regime. The rest are in museum, but this is something which was still trying to find work within that system, which developed almost 100 years ago, and hardly by few countries. I think India was, of course, not participating in that discussion at that stage when these rules developed after the League of Nations took it up. I think you know all those. I don't want to go into details of the economist report, but the 4 economist report and the subsequent League of Nations discussions. But to anchor back the discussion, why we are looking at Pillar 1 and Pillar 2 is what have been already referred to by Rashmin ji, is that there are 2 fundamental problems in the existing rules. One is the nexus rule, that is who gets the taxing rights, which is anchored to physical presence, and a profit allocation rule, which I think Pramod Kumar sir was referring to, based on that hypothetical presumption of separate entity principle, even though they are on the same group, but in many groups, independent entities are taxed on the basis of arm's length, which is essentially a separate entity principle, as if they are independent and separate from each other, which in reality they are not. And the synergy benefits that a group generates as a result gets captured only in the resident jurisdiction and not in the source jurisdiction or the market jurisdiction, as Mr. Rashmin was explaining. Now, the all-pervasive digitalization of the economy has rendered these rules, the nexus rules and the profit allocation rules, ineffective, if not completely obsolete. Businesses, as Rashmin was referring to Google type businesses, they can be heavily involved in the economic life of a country. They can have customers, they can have revenue, they can sell their products and service their customers without a physical presence. As a result, the market of the source jurisdictions are losing out on taxing profits, which, that I always say, that which they would have taxed had digitalization not happened. So in a sense, what we are trying to do now, what we are trying to reform, is restoring those taxing rights which have been lost by the market jurisdiction because of digitalization. And the ALP, the arm's length principle, those of you who deal with transfer pricing will know. That principle has been the bedrock of allocation of taxing profits among the entities of the MNEs. But this ALP, I mean, honestly, I am quite agnostic about ALP. I feel it's not a very fair principle. But more important, once digitalization has taken place, the ALP fails to allocate fairly taxing profits among jurisdictions which host various parts of the MNE enterprise, particularly in respect of the digitalized business models which have scale without mass, in the sense they don't require huge tangible assets. They don't require manpower. I think if you get an opportunity, you can look at a very interesting paper in the Harvard Business Review, Death of Financial Accounting. That should be interesting for professionals like you. How, let us say, Facebook, which makes a loss, but its share goes up, and what is its market value to its tangible asset ratio, and compare that with a company like Walmart, where what is the ratio of its market value, market capitalization, and its tangible assets. In case of Facebook, the tangible assets to market capitalization is huge because its real assets are outside the books. The real assets of Facebook are its users. They are not there in the books. So there is a limitation to the financial accounts, the way we understand it, the way we write it. And the investors, so the stakeholders, they don't look at the financial accounts which shows a loss. They look at how many users have gone up in case of Facebook, and that is why they place a value. That is why they see the profit that it is going to make, which pure and simple reading of accounts of Facebook will not give you that perspective. Now, the BEPS 1, as Mr. Rashmin Sanghvi was referring to, it did not address these problems comprehensively, because there was an Action 1 report about the digitalized economy, how to have the address the problem of nexus, and also the Action 8 to 10 reports on transfer pricing, how to make it more appropriate and to take out the defects in the transfer pricing principles. But the limitation of BEPS 1 was that by its very nature, it was designed not to look at the fundamental issues like allocation of taxing rights. It was primarily designed to address concerns relating to base erosion and profit shifting, which was happening by taking advantage of the existing rules. So it was basically an exercise to plug loopholes. It was not an exercise to write new rules. And because of that, the way it delivered in October 2015, the 15 reports came out, countries were highly disappointed. I think Mr. Singh has referred to Britain coming out with DPT, Australia came out with MAL, multinational anti-avoidance law, we came out with equalization levy, and most countries followed with digital service taxes. That was a collective disapproval of what has happened in BEPS 1, or at best an indication or an expression of discontent that what has been delivered is not enough, neither for the governments nor for the civil society. I think, again, Rashmin was referring to the 2012 Public Accounts Committee discussion. Those videos are available on YouTube. Please have a look how the British MPs are grilling representatives of Google, Facebook, and Starbucks. Now, because of this disappointment, because of this discontentment, the countries within a year joined in Tokyo, Japan in 2016 and created what is now called an inclusive framework, which is now, as on date, has a membership of 139 jurisdictions. They are the countries or jurisdictions which have committed to implement the BEPS 1 outcomes like CBCR, like anti-abuse rules, PPT, and there should be no double non-taxation, etc. You know the common minimum things which are to be implemented by under the BEPS project. And it was decided then that, in fact, it was decided in 2015 itself that the things will be reviewed in 2020, which I think was Mr. Rashmin was referring to. But in 2016, the G20 mandated this inclusive framework that please come out a comprehensive solution by end of 2020. And in that pursuit, if you are interested, you can look at several papers have been released by the inclusive framework, which are published papers, and they are very interesting and thought-provoking papers. You start with 2018, the interim report, and then we have a policy note in 2019 January. Then we have a public consultation report in 2019 March. Then in May 2019, we have a work plan. Then another unified approach document and public consultation in October 19. Then a discussion and a public consultation report in December 19. And then two very good documents, if you have time to look at, Pillar 1 Blueprint and Pillar 2 Blueprint, published in October 19. And then a public consultation in 21 January. And finally, the inclusive framework statement, which has been issued on 1st of July. Now, the final solution is expected to be within the indication, the outline that has been given in the statement in July, which is expected to be finalized by October 21. And there are some open issues which needs to be discussed and finalized by that time. Broadly, as I think Pramod Kumar Sahab also referred to, the solution is based on two main pillars. The pillar 1, as it is described, it focuses on allocation of taxing rights and seeks to undertake a coherent and concurrent review of both the nexus and the profit allocation rules. And the pillar 2 focuses on remaining BEPS issues and seeks to develop rules that would provide jurisdictions with a right to tax back, where other jurisdictions which have the taxing rights do not exercise their primary taxing rights. Or the payment that I make, any country makes to another country, and that payment is not subject to effective taxation in the country where the recipient is located, then the source country develops, has the secondary taxing right to tax that payment. In effect, the pillar 2 tries to ensure that the large and profitable MNEs pay a certain minimum amount of tax. I'll broadly go through, because of the lack of time, I'll just touch upon certain points, and rather I would like, if you have any questions, we can discuss that. On pillar 1, its scope. Who are the companies will be in scope? The companies will be in scope which have a global threshold of 20 billion and a profitability of 10%. Certain industries like extractives and regulatory financial services, because of public finance regions, because where it is considered that the rent, the economic rent, belongs to the country where these mines are there, and for the banks and all, because of the regulation they undergo on their capital and their profitability. So these are thought that there is no need for these profits to be shared with another country. The turnover threshold will be reduced to 10 billion after almost 7 years. And the nexus, as you have been discussed too, for out of this profit which exceeds 10%, certain part of the profit, which will be somewhere between 20 to 30%, which needs to be agreed by October, will be allocated to countries where there is, the MNE has certain level of sales, which will be around 1 million in respect of most countries, 1 million euro. And for smaller countries, it will be 250,000 euro if the GDP of that jurisdiction is less than 40 billion. Here, as you are referring to, the digitalization has rendered the physical nexus irrelevant. Here, the nexus will be established purely based on sales. It doesn't require a physical presence. It doesn't require anything. So sales becomes the indicator and enough to establish a taxing rights for the jurisdiction and for getting that amount A, so far as these companies in scope are concerned. There are, of course, the elements like, because it is, as Pramod Kumarji was referring to, first time we'll have in the worldwide scale a taxation of a group, of its group profits, which will be, of course, based on its consolidated financial accounts. And therefore, the existing dispute resolution mechanism for allocation of this amount A, of this residual profit or super profits or not normal profits, whatever you call it, because that will get allocated among, say, for a company like Google, maybe around, say, 150 countries. For a company like Amazon, it may be 160, 170 countries. So the existing rules that we have dispute resolution, like, say, MAP or our domestic courts, that will not be able to answer these questions, which are essentially multilateral. Because if you imagine one country says it is, I want my amount A should be X plus 1, that 1 has to come from another 179 countries. Therefore, there has to be a separate multilateral dispute resolution panel, and that panel will consist of tax officials, maybe retired, maybe serving. And while I appreciate what Pramod Kumarji was saying about his disappointment that whether those panels should be effective, whether the officials should be able to take decisions, but I would like to look at these disputes in a different context. These disputes are about sharing allocation. What is MNE's major concern? A group's business, its concern primarily is that I have 100 rupees. Please distribute that 100 rupees whatever the way you want, but don't end up distributing in a manner that the tax becomes, the profit becomes 105 or 110, so that I have to pay more tax than what profit I have made. So basically, it's a distribution. And who are the agreed parties here? So long as we distribute that 100, the agreed parties are basically tax administrations. That out of that 100, I should have got 7, but you have given me 5. I think MNE should not be bothered. So long as it is 5 or 7, total adds up to 100. But the tax administrations are bothered, because if you give me 5 instead of 7, then somebody has to give that 2. Somebody has taken that 2 from me. So it is basically primarily a dispute likely to be between tax administration. Therefore, maybe the tax officials should be able to resolve it. We can discuss later on if it's necessary this matter. Pillar 2, I think it consists of primarily a rule of income inclusion rule, which imposes a top-up tax on a parent entity in respect of low taxed income of its constituent entity. Let us say there is a parent entity A in country A. It has a wholly owned subsidiary B in country B, and the B has 100 rupee income. But as per, let us say, the agreed rules, the tax should be 15%. In that country B, the tax, let us say, 5%. So on 100, the tax has been 5. So the country A, where the parent is located, gets the right now to tax the income of the entity B in country B by the amount that has been not taxed. So it can top it up by from 5 to 15. Let us say if the 15 is agreed to be the minimum tax rate, then 10 rupee tax can be collected by the country of A from the parent entity A in respect of the income of B, because it has suffered tax at 5% instead of 15%. So from a MNE perspective, it doesn't help now to locate an entity in a jurisdiction just for tax purposes, because even if it doesn't pay that tax in that jurisdiction, it will end up paying tax in its parent jurisdictions. And then, of course, there is a undertaxed payment rule which will operate. Suppose the country A doesn't impose that IRR. Suppose it is again a low tax jurisdiction. Suppose the parent entity is located in a low tax jurisdiction. Then what happens is that any income that is flowing through that B or A, the countries from which these companies are making business, they can tax to the extent of that 10 rupees under the undertaxed payment rule. They can have that rule. It is a backstop to income inclusion. Then, of course, we'll have a treaty-based subject to tax rule, which is very important for countries like us, for countries, developing countries, for source countries. That if I have given up a right in respect of taxation of a particular income, let us say capital gains. Now, let us say under the treaty, I have given up the right that capital gains will be taxed in the country where the alienator, that the person who has sold the asset, is resident. Now, suppose that country doesn't tax it, then automatically the country, other country to the treaty will have a right to tax that payment, that income, whether it is capital gains, which is to be agreed, or any service payment. Suppose I have made to another country, which has a base eroding effect on my business, because that is a deduction in India from the business, and that amount has been paid to another country, it is not taxed. So this amount, to that extent, it is not taxed appropriately. The rate is to be decided, because the gross rate tax will be little less than the 15%. It will vary between 7 to 9%. And if it is not taxed, then I will be able to tax that payment or that income under that subject to tax. The global minimum tax rate is expected to be at least 15%, as the agreement is, and let us see what happens, but it will not be less than 15%. Now, I would like to conclude at this stage that just with a couple of comments, giving a broader perspective what we are looking at here. Now, this two-pillar solution, it is introducing significant changes to international tax rules. That is something we need to recognize. And as I think it is absolutely correct, as Pramod Kumar is saying, that we always try to have a static solution to a dynamic problem. But the changes that we are looking in international tax system, or what has happened over last 5 years, I think it is more than what has happened in last 50 years. And going forward, I am sure what the changes that will happen in international tax landscape over the next 5 years, it will outstrip the changes that have been introduced in the last 100 years. And that is the level of change we are now looking at, or should be prepared for in international tax landscape. From Indian point of view, the principles underlying Pillar 1, when I say India's point of view, it is a point of view not only of Indian revenue, but a point of view well articulated by our tax experts and scholars like Rashmin Singhvi and P.P. Oswalji and many others, and of course by the Indian revenue, that there should be a greater share of profits for the markets. There should be a consideration of the demand side factors in profit allocation. Profit allocation so far is only on FAR, which are basically supply side functions, assets, and risk, not the sales or the system or the ecosystem which supports that business, as Pramod Kumarji was saying. And second, the need to address the issue of cross-border profit shifting and a subject to tax rule, which will address our concern of treaty shopping, which we have faced in respect of a couple of treaties. All of you are aware. I don't want to go into that. Now, in Pillar 2, one last thing I would like to say about the narrative. The narrative, how it is changing, and that is what was Pramod Kumarji referring to. What will be the role of a professionals like you in the changing narratives? Now, the narrative initially in international tax landscape, when you design double taxation avoidance agreement, was that to avoid double taxation, that it should not be taxed twice. The next we had the BEPS one, where the narrative was that M&E need not be taxed twice, but we must also ensure that it is taxed at least once, so that we should avoid a double non-taxation of income as they were taking the benefits. Now with Pillar 2, the emphasis is on having a minimum level of tax, ensuring a minimum level of tax. That is what the world is moving. That is where the narrative is moving. That is why the stakeholders are there, and international tax principles now are discussed on international tax discussion, which are normally used to be very boring and only left to the experts. Now they have been mainstreamed into the international discussion. If you have to look at a G20 communique, you have to look at a G7 communique. I think over the last 5 years, there is no G7, there is no G20 communique. They are the two most powerful political groups or economic groups in the world now, without a reference to change in rules for digitalization of economy. There will be at least 2 paragraphs in any communique that has been issued over the last 5 years. That is what the mainstreaming of the discussion. And therefore, as professionals, as Pramod Kumar is saying, we need to look at now, ensure not only to be abreast of what is happening, but also ensuring that the clients pay a tax which is payable by them. Not that they should overpay, but they should try to pay and pay a certain level of tax which the law demands or the commands. And that is, at the days of looking at avenues how to reduce tax rates, how to reduce the overall incidence of tax is over. Because if you are particularly looking at the M&E groups, if your entity doesn't pay tax here, the group will pay elsewhere. And since this rule will become, the tax rates cannot be separate for the M&Es or for the domestic business, there will be, you can expect now going forward, which of course has been the policy of the government since 2015, that exemptions of income incentives will go away and only the tax rates will be moderate and low. So we are looking at a big transformational change in international tax system. What it will bring to us, so far the pillar 1 is concerned, I think once you have a system where a part of the profit, and these are companies which have huge profits. Now, I think in terms of, they are almost, most of these companies' profits exceeds GDPs of many countries combined, not only single countries. Now, once we have a share agreed upon based on sales in India, then you can expect that our shares, our profit tax base will definitely expand. Because going forward, as Indian economy grows and our purchasing power of our countrymen grows, only Indian sales as a share of world sales in most of these companies will only grow. I'll give an example. I'll not name the company, but this is a company where the phones most of us use these days. It's an American phone making company. Now its global turnover between say 2017 and 2020 grew by 7%, whereas its Indian turnover grew annually by 29%. So what I'm saying is that our share, Indian sales share and the global sales share in most of these companies will only go up. And therefore, we can only gain because being a huge consumer market in terms of pillar 1. In pillar 2, I expect that the pillar 2 will induce behavioral changes. You will not have normally a low tax jurisdiction now, because why it should have a 0 tax or a 5% tax when the balance 10% or 15%, as the case may be, will be taxed in the other country. So most likely the tax rates will go up and the MNEs will lose their interest in shifting only because of a tax rate or a favorable tax climate. And this is likely to increase the cost of profit shifting, because now if you are shifting because it was a 0 tax, it makes sense. But if you are shifting because you get a advantage of 2, 3, 5%, it may not be worth it. So the tax base of most countries, particularly the developing countries, is likely to expand. In fact, OECD expects that the total revenue gain from pillar 2 will be around $150 billion US. And forget about OECD. If you look at even enterprises like BEPS Monitoring Group, which an NGO, many of you would have heard of it, or Tax Justice Network, all of them have commented on the pillar 1, pillar 2, and have said that pillar 2, the revenue of most of the developing countries will go up, and pillar 1, definitely the market countries will benefit. But end of the day, of course, this is a compromise solution. I think as Oswalji was referring to India, from India side, we gave a proposal of significant economic presence. It's part of our law. We wanted significant economic presence with a fractional apportionment to be there, but that agreement could not, there was no agreement on that proposal. But we have now where basic principles of what we are saying, of a market-based taxing rights, of a profit allocation based on sales, these have been accepted. Of course, it is, as I always say, it's only the beginning. And definitely we are in the right direction. Why is it is quite right? As the Indian government said in its press release after the inclusive framework statement came out, that we look forward to having a higher profit allocation, which is to be decided under amount A, the pillar 1, and a wide subject to tax rule, which will give us protection and also a taxing rights in the case our TT partner doesn't tax those incomes at a particular level. I think I will stop here, and maybe Oswalji and others can comment, and Pramod Kumarji can also moderate what I have said. Thank you very much.
Many thanks, Das sir. You have in a very short period covered all the issues which are important in pillar 1 and pillar 2.